All right, hearing it out from more top market voices, a resounding belief in the India story. India is a much more stable economy versus neighboring China. But are the macros enough to pacify the turmoil that we've seen in the equity markets? We caught up with Naren to understand his views on the road ahead and macros.
See, the challenge is China at the end of the day is not a democracy. In a democracy, I learned from my Russia experience that, when you don't have a democracy, there are challenges. Having said that, purely on valuations, China is really cheap. But do you understand the economy? The answer is no. What on valuations, they are cheap. Does it make sense to invest big money? Answer is no, because you don't know what is there in all that. But what we learned from 2012, 13, 14, if all your debt is domestic, and if you have current account surplus, which is the situation in China, there are a lot of flexibilities that China has. Overnight, you can do a lot of things. You're not dependent on the rest of the world to fund you. You have a current account surplus and a huge foreign exchange reserve. So you can do a lot of things. It is just that the Chinese government has decided that this is what we need to do, and that's why they are continuing to do what they want to do. Can they give a big consumption bazooka? They can, because they have the capability to do it. It's not that they are dependent on the rest of the world to fund them. So that is the kind of situation. But India is a much more stable economy. It has much more, the debt part of the economy across the value chain is very comfortable. Corporate debt is comfortable. Government debt is comfortable. Household debt is going up, but very comfortable. So I would say we are in a much better position from a macro point of view.
Can we come back to India, Naren, now? We've discussed global macros, Trump. Let's get S. Naren's view on India now. One very big concern which has surfaced up after the last quarter numbers is that earnings are slowing down, demand is slowing down. And that is a real deal, Naren. Auto sales, FMCG sales, whichever way I look at the high frequency data point, even on government spending, they are indicating that the economy is slowing down, something which markets were not prepared for. What is your view on demand and earnings now?
See, I'm not yet willing to throw in the towel there because, see, you have to remember that you had elections in May and you had a very good monsoon this year compared to last year. And you had a festive season, which you have to handle because at the end of the day, if you look at October auto numbers, they were very good. So I think, you can throw in the towel after, maybe December result or something like that. And it's too early to throw in the towel and say that the capex also has not been spent by the government of India because of the fact that you had a situation where the elections did delay some of the expenditure by the government of India. Look at the way fiscal deficit is of central government. It's been fantastically low. So I would say that it's yet too early to throw in the towel and say that the economy is slowing down. The challenges is only coming, in my opinion, from valuations and not yet from the economy. Because see, people used to say credit growth is too high, deposit growth is so slow. Look at this year, deposit growth has picked up against credit growth, so that issue is resolved. So I would still not say that there is a serious macroeconomic concern on growth. There is a clear problem that some sectors like FMCG, which is catering to a larger part of the population, have been struggling for years. And we hope that those kind of sectors start to do better. But overall, I don't think there is such a serious problem on economy. I think earnings is certainly was a problem in the September quarter. And I think in the December quarter, things will be slightly better. But the problem is that if you look at most small cap and mid cap, you're giving them 60, 70, 80 PE. Is it justified? No. But the reason they are being given 60, 70, 80 PE is because there is continuous inflow into small and mid cap funds. And due to that, the funds buy at 60, 70, 80 PE. And that is the challenge, if you ask me, is the problem rather than the economy. I don't think economy is the problem. And I don't think earnings is as serious a problem. If you look at banking earnings, they've been very, very good. And select sectors of the economy are still doing okay. IT did reasonably well. Pharma did reasonably well. So, and some of the, I would say festive oriented sectors did pretty badly. And let's see what happens in the December quarter.
Enviro Infra Engineers Limited now proposes an initial public offer of its equity shares. The 100% book built issue is being offered at a price band of rupees 140 to rupees 148 per equity share of face value of rupees 10 each. Issue opens on Friday, November 22nd, 2024. Issue closes on Tuesday, November 26th, 2024. For risk involved and other details, please refer to the Red Herring Prospectus, which is available on the website of the company, SEBI, stock exchanges and the BRLM, Hem Securities Limited.